Hi, welcome to my channel. If you're coming back from one of my previous videos, thank you so much for coming back. Today I'm going to be talking about the surprising things that can actually affect your credit score negatively. One of those being your own husband. Hopefully this video helps someone and we'll just get right into it. Did you know that you can actually become linked with someone on your credit file? This could be a husband, an ex-husband, and an ex-boyfriend. Yep. So the way this happens is that if you take a joint agreement, by joint agreement I mean like a joint bank account, a joint mortgage with someone, you actually become linked with that person and they become a financial associate. So that means that whenever someone looks at your credit file, they will see that you are linked with this other person. And if this other person's credit score is bad, it will actually drag you down as well because you're linked. So just to let you know as well, just because someone is your husband doesn't mean that they're linked to your credit file. You will actually have to have a joint agreement with something for you to be linked. So again, like I said, you will actually have to have like a joint account, a joint mortgage, something like that to actually link you together. There is a way to actually get this link taken off. The only way you can get it taken off is if that joint account is closed. So if you have a mortgage with that person and you plan on still having that mortgage, unfortunately you will have to stay linked. So it could be that if you bought a house with a boyfriend or a husband and that term is not finished, you're still paying off that mortgage and both your names are still on that. If that person then has a bad credit in the future and you still have that mortgage with them, they will actually negatively impact your credit score. You can only take it off if you finish paying off that mortgage, if that mortgage is now only in your name or only in that other person's name, which is not great. If it's the fact that you have a joint account, let's say a joint credit card, then it will be a case of actually getting your name removed or getting their name removed or just completely closing the account down. The other thing that surprised me was actually that, so as far as your credit score, they actually care about the credit you take out. So let's say you start thinking about improving your credit and then you take out a credit card. Well, the thing is, they actually want to see that you have a diversity of credit on your credit file, which is, that's another part of it. So you actually have to have, let's say, a credit card, a mobile phone, maybe a car insurance. Basically, you just have to have a diverse student loan could be one of them. They just want to see that you can manage different types of accounts and it's not just a case of you're just having loads of different credit cards or loads of different loans. They actually want to see that you have loads of different types of credit, that you have a mortgage, let's say. So you have to actually mix up what you have. It's almost like a portfolio. You have to have different things on it to actually improve your credit. So if you only just have the one credit card, it could be actually limiting the credit that you have. Your credit score might be a bit lower just because of that, just because you're not diverse enough. So most people have car insurance. Well, I hope they do. If they have a car, you kind of have to have that. But if you pay your car insurance monthly, it actually does get added to your credit file, because technically by you paying monthly, it means that you're borrowing from the insurance company and you have agreed to pay them monthly and they will charge you interest for this. So if you miss a payment on your car insurance, that goes straight to your credit file and it definitely does, decrease your credit score. So that's definitely something to think about. If you do pay the insurance in full, then in that case it won't actually show up on your credit file because you would have just paid it. It's only if you're paying monthly that the insurance company does actually put that onto your credit file. So make sure not to miss any of those payments as well. Avoiding credit. So this one's really sad. So I feel like this is just to make sure that people put into this whole world of credit score and you have to follow the rules and everything like that, because you pretty much have to have credit if you want your credit score to be higher. If you don't have any sort of credit, you have no history, your credit score will be in tatters. So you definitely have to actually take out some sort of credit if you want your credit score to be good, if you want it to be high. And if you plan on ever buying a house using a mortgage, you pretty much need that credit to be higher. Or if you ever think of making a massive purchase like a car on finance, you pretty much have to have some sort of credit to show that you are trustworthy and you will pay it back. So yeah, definitely don't avoid taking any credit. Just make sure the credit that you take, you're taking it intentionally, knowing that you can pay that off, and you'll be comfortable paying that off. It's not going to strain you. Opening and closing accounts. So opening an account can actually affect your credit score negatively. So the reason for this is, one, if you open a new credit, that probably means that they've done a search on you to accept you in the first place. And usually the searches that they do to actually accept you for credit is a hard search. With a hard search, that does decrease your credit score. The other thing it could be is it will actually decrease the average length of your credit. So one of the things that actually increases your credit is if you have long-standing accounts. So if you have a card that's like, you've had this card for 12 years plus, it will increase your credit score. But if you only have accounts that are like a year old, 6 months old, then that actually doesn't look very good on your credit score, and it will lower your credit score. So that's why when you get a new account and some sort of new credit, it will actually decrease your credit score quite a little bit. The other thing is obviously closing an account. It's the same reason really. It will likely put down the average length of your accounts, how long you've had them, because it might be that you're closing an account that you've had for quite a long time, and that will decrease the average length that you've had all your accounts for. And that's it. Those are the most surprising ones that I thought of anyway, that negatively affect your credit score. And again, if you enjoyed the video, please leave a like and subscribe to my channel. I will be making more videos surrounding just financial information that I found that I had to learn by myself. They should really teach this in school, but I'm hoping that these videos are helping someone out there. Thank you for watching again. Bye.